Have you ever wondered whether RSI or moving averages give better trade signals? You're not the only one. Both are extremely popular indicators, but they work very differently. In this video, we'll break down how each one works, compare them side by side, and help you decide which fits your strategy best, or if combining them gives you the real edge. And here's the best part. At the end of this video, we'll look at real chart examples to see how these indicators actually perform in real market conditions. So stick around till the end, these few minutes could change how you trade forever. Quick overview of indicators. RSI. The Relative Strength Index, or RSI, measures the momentum of price changes. It ranges from 0 to 100 and is typically used to identify overbought and oversold conditions. Readings above 70 suggest the asset might be overbought. Readings below 30 suggest it might be oversold. It's a fast-moving indicator, ideal for short-term traders who want to catch quick shifts in momentum. Moving average. A moving average smooths out price data over a set period of time. There are two main types. Simple moving average, SMA, averages the closing prices over a period. Exponential moving average, EMA, gives more weight to recent prices. Moving averages help you identify the overall trend direction and potential support or resistance areas. They're great for spotting trend continuation or reversals, especially when used with crossovers. RSI versus moving average, key differences. We'll begin with a quick side-by-side comparison of RSI and moving averages. Then comes the real value, seeing how they actually behave in real market situations. You don't want to miss that part. Let's break it down. As for indicator type, RSI is a momentum oscillator. It's designed to measure the speed and strength of price movements. In contrast, moving averages are trend-following indicators that help traders identify the overall direction of the market. When it comes to market conditions, RSI performs best in ranging or sideways markets where price fluctuates within a defined range. On the other hand, moving averages shine in trending environments where the price steadily moves in one direction. In terms of signal timing, RSI gives faster and often earlier signals. This can be great for catching quick moves, but it also comes with higher risk. Meanwhile, moving averages generate slower, but more stable signals, offering reliability over speed. The use cases are also different. RSI is ideal for spotting overbought or oversold levels, alerting traders to potential reversals. Moving averages are better for identifying the current trend direction, giving clarity in longer-term trades. What about false signals? RSI can produce more false alerts, especially during strong trends. Moving averages generate fewer signals, but they lag more due to their smoothing nature. Finally, when it comes to reaction speed, RSI responds very quickly to price changes, which makes it great for fast signals, but it can also be too sensitive at times. On the other hand, moving averages react more slowly, but their smooth behavior makes them excellent for confirming the strength and direction of a trend. So, depending on your style, aggressive or conservative, one may suit you better. Or better yet, use them together. Chart comparison examples. RSI gives early signal, moving average confirms. Here, RSI dips below 30, suggesting an oversold market. The price begins to reverse shortly after. The 50-period EMA is still trending down, but as price crosses above the EMA, that's when the trend gets confirmed. If you entered with RSI, you got in early. If you waited for the EMA crossover, your entry was later but safer. Next example. RSI triggers by early, EMA confirms with trend shift. The market has been falling for several sessions. RSI drops below 30, enters the oversold zone, and a few candles later, it crosses back above 30, triggering a potential buy signal. The price begins to bounce, but it's still trading below the 50 EMA. Only after the price closes above the EMA, and the moving average starts flattening, or turning up, a more reliable confirmation appears. The RSI gave an early signal, allowing for a quicker entry, but with more risk. The moving average gave a delayed confirmation, filtering the noise, and signaling a safer entry, once the trend actually started to reverse. Which one should you use? So, which one is better? RSI or moving average? Want fast momentum-based entries? RSI is your tool. Prefer trend-confirming filters? Then moving averages are your friend. But why choose one when you can use both? Use RSI to spot early opportunities. Use moving averages to confirm trend direction. Together, they form a powerful combo that balances speed with reliability. You'll find a link to my RSI plus moving average combo strategy video in the description, don't miss it. Today, you learned the strengths and weaknesses of RSI and moving averages and how to use them the smart way. Next video, RSI versus Bollinger Bands, it's gonna be another eye-opener. Smash that like button. Subscribe. Comment below, which combo should I cover next? Trading isn't about luck, it's about smart decisions. Let's get smarter, together.